Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
The Taiwan index is down 1.6%. We have Hang Seng that's down 0.4% in the trade.
All of the respondents to the CNBC-TV18 poll expect the Monetary Policy Committee to leave the repo rate unchanged at 5.25%.
Actually under 96, so prices move around a little bit, so 95, 96 around those levels. I think we're at about 23,500 plus, so this is a 100-point up move on the Nifty.
Nifty has clearly underperformed in absolute and relative terms. Large caps have gone nowhere. Nifty has seen no dollar returns in about 5 years.
The MPC voted unanimously to keep the policy repo rate under the LAF unchanged.
FPI bond investor point of view, the tax is gone and more number of instruments are available to them under the fully accessible route. Are you expecting your investor clientele to be happy?
And the fact of the matter is that there is a huge amount of interest that we have seen of people wanting investment in government securities.
Nifty, a sharp uptick since the time we saw these announcements come by as well. It is up 53 points above the 23,400 mark. Across the board, we are seeing that recovery.
That when the tide will turn, we can have some of these participants put in their dollars into the Indian market.
We are hopeful of reasonable and good. We are not targeting any particular amount, but we do expect healthy flows.
Has been quite volatile. For now, we are below that 23,400 mark by a big margin, actually very close to that 23,300 mark.
Well, this is closing bell. That was a day so far. Last hour coming up, not just for this Friday, but of course for the week as well. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, Nigel. Nigel, hi. Afternoon.
Well, what a volatile trading session, Prashant. You know, the bears would have thought they were in with a chance. You know, just till I think maybe around 20 minutes or so ago when we were down 120 points. And the bulls, well, they have dominated most of the trading session. The good news, I think, today is irrespective of what the equity markets do, is the rupee has shown some stability. There are measures that have been announced. The rupee is responding to that. And I still think, you know, the last 60 minutes or so, maybe, in fact, there is still some optimism that the bulls have some unfinished business, maybe at around the 23,800 odd mark. So it appears the structure, though it got broken a couple of sessions ago, I think maybe I'll have to lean towards the positive bias from these levels.
Well, 23,350. So we're about 65 odd points lower. And, you know, we'll just have to sort of wait and watch, because the other way to look at this is even, I mean, there was a fair bit of expectation. Was there really a huge amount of pre-positioning going into it, which is getting unwound? Maybe yes. But I think, you know, at the margin, if the market is not able to hold on after what the RBI has done, by the way, RBI has announced a slew of things, right? There's been nothing negative. On the positive side, you can say, well, how much money, how much dollars is this, all these measures going to be able to attract into the country? But if after all of it, markets are not able to hold on, you know, it just kind of sort of, you know, points to the underlying weakness that we have on our hands as well, and a general lack of, at least as far as large caps are concerned, a general level of disdain, and you know, people just shrugging their shoulders off. Mid caps, though, is a completely different story, as we've pointed out for a while now, and that's mostly going to be the focus point over the next 60 minutes or so as well. Well, let's just get trades out of the way. Rahul Mohinder is with us. Rahul, good to be speaking to you. It's been a while, I guess. Good afternoon. How would you see things, and what would you do?
Good afternoon. I think first of all, the market does, as you clearly mentioned, does look a little soft from a Nifty perspective, and I clearly agree with you. It's mid caps where traders are focusing on. That's where the action is, and you know, let's get to some clear stock specifics which we could be looking at. I'd say power finance. That's an interesting one. We're seeing a bit of an intraday move right now, but I think we're good for about a target of 465 to 470. I'd buy it with a stop loss of 416. Another one which comes in my radar, which seems to be outperforming, is Cipla. And this one is not just a short-term call, but you could extend this call out to a medium-term trade as well. I think in the near term, yes, 1460 is a likely target, but long haul, I do expect this to move towards 1540, 1550. I'd keep 1365 as a stop loss for buy trades. And another safe spot, in my opinion, would be LIC Housing Finance. There too, I'm looking at a move to about 585, 590, keeping a stop loss of 530. And again, the view would be that the index may not be singing that song. And just to kind of talk a little bit about the Nifty, I still feel we're probably heading to about 22,850 to 22,900. The only thing that would change my opinion on that is if we suddenly see a move past 23,500. So, in the main, I'm kind of medium to negative, sideways to negative on the Nifty index.
So you'll generate a fresh shot, right, at these levels?
Well, even at these levels, I think you're still good for a fresh shot, but keep in mind that 23,500 is a block hole. That's a level we've got to keep, a stop loss at when trading.
And the Nifty Bank, that's been a relative outperformer this week. That would be a shorting candidate as well?
I would say yes, but, I would be more tilted towards the Nifty. On the Nifty, if we look at the Bank Nifty, yes, 55,500 approximately is your near-term resistance. But, I don't identify, 2 or 3 top names within the index, which I think would really go down. I think it's going to be more lull in comparison. So I would say within the indices, my pick is go short the Nifty.
Yeah, go short the Nifty. That's the view. And single stocks, I think we've sort of covered that. We'll get Rahul back in a bit and just run us, get you more. But for now, that's the view. Those are the trades. 60 points lower, 23,360 or so is where we find ourselves at. Gurmeet Chadda is with us, Managing Partner, CIO, Complete Circle. Gurmeet, good to have you with us here. Thanks for joining in. So lots of measures, right? All together in that meeting. And lots of all kind of numbers doing the rounds. How much can this get in? I think Samir Arora of Helios has just posted on Twitter saying, well, $30-40 billion is his estimation, and there are others as well. Just your thoughts, Gurmeet. How significant is this? And I mean, relate this to financing conditions here in India, and of course, yields and banks, etc.
Thanks, Prashant. I think very significant move, Prashant. And debt flows are often underappreciated and a distant cousin of equity flows, if I may say that. Since the time India made those amendments in FAR and got included in the global bond index, one of them, we have got about $19 billion kind of a debt inflow. And I think the outflow from debt has been very minimal in terms of the FX outflow, of which I think the FAR, which is fully accessible limit, was almost 11-12, and the general route is about $7-8 billion. So we've just got like 6-7% of the eligible amount we can get. So this is significant there because we don't know. It's right now difficult to pen how much, but it is quite significant. Both for once we have the inclusion in global bond index, maybe $20-25-30 billion from there, and FCNR could be another 20-25 because this time it's a 90-day limit. Secondly, if the RBI hedges it and you get that 3.5% bank gets more, which can be passed through to the customer. And some, the mix of the lending mix will also change. The banks will also benefit. The entire hedging would not be, passed on. So I think it is pretty significant and less underappreciated. And I think over a period of time, I agree the number could, with the GSEC route and the FCNR route, it could be anywhere between $30-40-50 billion. We could see, and much needed considering the outflows we have had. Equity is something which continues to, I think, see very good outflows. I just hope that something follows through there as well. Some bit of tweaking in either capital gain, STT, some kind of a relief there, I think would really help the overall sentiment. But I think it's a good start, and I think it's good to see some coordination with RBI and government, both the government coming up with LTCG and withholding tax relief, and RBI allowing, and now they're allowing more GSEC maturities in the FAR route as well. So I think it's a good move. Some of the market doesn't seem to like it too much so far.
Yeah. Gurmeet, it's a pretty rounded answer and way to think about this, both from a debt flow perspective and what it can mean for equities and financials in particular. But let's just address one more important story. Now, Tata Sons board meet is scheduled for Monday. This is 8th of June. And ahead of that, we understand a fresh complaint has been lodged by the Mumbai Charity Commissioner. And this is important to take note of. Shireen is getting us the story. Shireen, take it away.
Well, thanks very much. Yes, the trouble at the House of Tatas continues, and what we are giving to understand is that a fresh complaint has been made with the Mumbai Charity Commissioner ahead of the crucial Tata Trust board meeting on the 8th of June. Remember, even in May, this was the case where the Charity Commissioner had then had to call off that Tata Trust board meeting on the back of a complaint that had been sent. Now, this is what the letter says. It seeks the intervention of the Charity Commissioner and it alleges the improper transfer of Tata Sons shares. Now, this is a matter that goes back to 1989. Let me explain this to you. The letter asks the Charity Commissioner to initiate an inquiry into the transfer of 833 equity shares from the Navaj Bhai Ratan Tata Trust. The letter has been written by the same gentleman who complained and had filed a legal notice in the month of May and had sent that legal notice to Tata Trust. It's been filed by Suresh Tulsiram Patil Khede. The legal notice has raised the issue of the transfer, as I was pointing out, of 833 equity shares of Tata Sons to Naval Harmasji Tata in 1989. It claims that the transfer was done to Naval Tata, who was no longer a trustee of the Navaj Ratan Bhai Tata Trust, and hence it was an invalid share transfer. And this is the basis of the complaint that's been made to the Mumbai Charity Commissioner, saying that Noel Tata was the beneficiary of those shares because those shares devolved to him, and hence there will be a conflict of interest for Noel Tata to preside over the Tata Trust board meeting. Now, Tata Trust to CNBC-TV18 hitting out very strongly against those allegations, saying that any suggestion of impropriety on the part of either the Ratan Tata Trust, NRTT or any of the parties in this transaction is being categorically denied. The Tata Trust says they affirmed that the transaction was lawful and was taken with full compliance of all existing rules that were in force at that point in time, going on to say that the proposal was cleared at the appropriate levels, including by the late Nani Pakiwala, one of the country's most distinguished lawyers, approved by the then board of Tata Sons. Transfer of shares was effected on a valid transfer form duly stamped by the Registrar of Companies. Tata Trust also then going on to say that the petitioner in this case, Suresh Tulsiram Patil Khede, is a serial litigator who's been in the past filing several cases against the Tata Trust without any locus standi. They believe that the allegations and these complaints are part of a willful, malicious and orchestrated campaign being undertaken with the sole objective of discrediting the Tata Trust. Now, this has been sent to the Mumbai Charity Commissioner. We will have to wait to see if the Charity Commissioner acts on this complaint and the board meeting scheduled on the 8th of May still stands, or will that also be deferred? Remember, it was deferred by the Charity Commissioner in the month of May. Back to you guys.
Well, thanks very much for that, Shireen. And I think it's an important one. The Trust's meeting coming up on Monday. So that is the Tata story with Shireen there. Well, let's just look at markets and, maybe a little bit more of a downtick, right? From the last time we looked at it, we were down 50 when we started at 230. We're down about 80. And there is, broader markets which have also slipped a little bit going into this Friday, last 40-45 minutes of trade. But, the multiple measures and which Gurmeet called pretty consequential and should attract a fair bit of flows, right? Let's just quickly summarize those measures with Ritu. She's, of course, been covering the RBI. She was there at the press conference. Ritu, take it away.
Well, yes, very quickly, Prashant, 50 billion kind of BOP gap is what most economists have been talking about that we could face. Some of these measures, and if you take what Gurmeet was saying, could actually significantly help bridge that. So, yes, it is a bazooka and it's a double whammy coming, not whammy rather, it's a bazooka from both the government and the RBI put together. These are pretty substantial measures that can help attract significant foreign inflows. On the taxation side, you have the government first, of course, saying that any kind of taxation, whether that is withholding tax of 20% or the capital gains tax of 12.5% for FIIs investing into government securities will be completely done away with. This is a huge positive measure coming in from the government. But from the RBI side itself, the universe of government securities under the fully accessible route itself has been expanded, which means, through this route, foreign investors can put money in GSECs without any kind of investment limit. Earlier, it was limited to only the 10-year government security bond. Now, the 15-year, 30-year and the 40-year GSECs will also be eligible. So a wider pool of government securities available for foreign investors to put their money in. Apart from this, the investment limit for NRIs and OCIs to invest in Indian equities without any SEBI registration has been increased. So there is one facilitation that has come in from there. Apart from this, there is a concessional forex swap to incentivize ECB borrowing by public sector enterprises for a limited window until September end 2026. Essentially, think of it this way, an NRI sitting in Dubai, for instance, wants to put money in deposits here. When banks take that deposit, they have to take this, dollar liability. So to some extent, there will be a concession there from the Reserve Bank of India. To what extent that comes in, we'll have to see. And lastly, RBI will also bear the full hedging cost for fresh 3 to 5 year FCNRB deposits raised by banks until the 30th of September. So this is one of the bigger measures that has come in. Last time around, we had this FCNRB window. We were looking at inflows of 28, 30 odd billion dollars. So if you're looking at a similar figure, perhaps it could be substantial. Initial estimates by economists say that, banks with this helping hand from RBI could offer interest rates as attractive as 5 or 6%, to NRIs looking to invest through, FCNRB bonds. So compared to the 4.5% yield you'd get, in US, for instance, that is substantial enough to attract these foreign investors, attract these NRIs to invest into deposits in India. So put together, it is pretty substantial, and all of these, of course, have already come into effect as we speak.
Got it. Okay. All right. Thanks a lot, Ritu, for joining in and filling us in with all of those details. Gurmeet, well, the markets are a little bit wobbly, but I'll tell you what, at the start of the show, I was mentioning that I think still the bulls believe they're in with a bit of a fight. If we look at the index right now, we were down 100 points approximately when we started off the show. I think we're down to 20 now. There has been a bit of a recovery that we have seen. And what's fighting back is actually the Nifty Bank. So from this pocket, BFSI, banking, financial, insurance companies, what are you all tanking up on?
Nigel, I think I had a discussion with few treasury guys of private banks. I think they're pretty excited. So, I think the liability mix will change. Especially banks with a very good NR base, like Federal Bank, which is dominantly more in South and Middle East, gets a lot of remittances. ICICI Bank has a very decent NR book. I think they would see the mix change. Also, some of the PSU lenders can use the ECB route to overall lower the cost of funds. I think that is something we'll see more action coming probably over the next couple of weeks there. So these are some of the preferred pockets. And I think Federal Bank also has seen capital infusion, change of guard with Mr. Manian coming in from Kotak. So I think things are shaping up well. So we've added a little bit more today in BFSI, especially in Federal and ICICI Bank. And we are looking at more PSU lenders in terms of what impact it has on cost of funds. But look at also the treasury income of the bank. I think that you should keep a close eye there. So there will be some mark to market. There has been a MTM impact because of yields hardening. I think the near term you will see yield softening as well, and the amount of money banks will make over the next 90 days in terms of executing this FCNRB. So pretty positive, and I think it's struggling. Entire bank Nifty is 12-13 times earnings, so looks reasonably valued, and maybe a good tactical bounce is up there.
Gurmeet, there is this Tejas Networks, right? Which I was just thinking about it with Shireen was just talking about. She was talking about the Tata Group dispute, etc. There are 4 businesses which have been highlighted as. The allegation is that they've been underperformers and they've not done well in this capital allocation. The 3 are unlisted. The only listed entity in that group is Tejas Networks. Highlighting underperformance can result in fixing the underperformance. I don't know how or what can happen, but that seems to be the direction markets are taking. It's actually bounced a little bit. I think about 25% or so since this entire saga started. The first time it was highlighted What's your sense? I mean, it's a company with strong IPs. There is no doubt about it. Tata's bought them in 2021 or 22. Very strong player in telecom, but lots of other industries as well, networking for data centers and actually lots of products. Any thoughts here?
There are three issues here. One, the 5G rollout from BSNL got delayed. So they were supposed to do some 5-6 lakh 5G microsite. One site is typically a few crores. So that order book into a few lakh sites would have translated into a 3,000-5,000 crore order book. That got delayed. And you had accumulated losses, the debt went up. So it was just poor execution after a stellar re-rating of the stock. But and then there's optical fiber network and network equipment, IP-related plays. I think you're better off playing maybe a Bharti Airtel or Indus Income. You want to play that. Bharti also, in my view, not comparable, of course. I think it's just because of largely FI selling. I mean, if you see, remove the capex part and the spectrum dues, etc., I think the free cash flow is upwards of 40,000 crores. And they continuously are adding more subscribers, more than now Jio for second consecutive month. ARPU will improve last quarter because it had lesser number of days. I think it's clearly, plus if whenever the Jio gets listing, Jio valuation is around $130-140 billion. Bharti is currently almost $100 billion valuation, maybe $105 billion valuation. So there are more near-term and long-term triggers there, both in the mobility business, enterprise business, etc., and with the Airtel Africa, IPO as well. And then promoters now talking of getting the stake back to 51%. So I think that, in my view, that's a better secular, less risk-averse way of playing this entire telecom equipment and infrastructure play. And then there is this optic fiber network. Gujarat government yesterday announced 5,000 crores for underground cabling, etc. So a lot of capex happening. So good cable and wire guys, and mainly 5G. I think that's a better way to play it.
Got it. Okay, all right. Let's talk about Wockhardt. By the way, markets almost moved into the green as we speak. So there's a massive recovery that we've seen from the time we started off the show. I think 85-90 point recovery is what we're seeing. The bulls will want to go home in the green. Let's see if that happens. But one stock that's under pressure is Wockhardt. That's down post the investor conference meet. We have Ekta who joins us to detail all of that. Ekta?
Well, yes, the investor conference took place last evening. It was with regards to Xenic, the antibiotic, which has been approved, and it is a novel antibiotic which has been approved by from Wockhardt stable by the US and India. So what they did say is that the expected launch in both US and India is probably in the next 6 to 7 months. Europe would be 3 to 4 months after the US filing. They're targeting 7 to 8 emerging markets as well in the next 18 to 24 months, which would include the likes of Latin America, GCC, Eurasia. India price expected to be 75 to 80% cheaper than the US. US, it could probably go to around $10,000 for a treatment as well. Initially, expect a slower uptake because hospitals will have that adoption cycle. They will be a little hesitant to use it. Eventually, you will start seeing revenues come through or traction come through maybe around FY29. Peak sales potential, $1.5 to $2 billion. And eventually, 12 to 18 months, you could probably see a near break-even or a small profit as well. The management expects around 10% improvement in margins over 3 to 4 years. Company shifting from a generics biosimilars business to being a global innovator pharma company, focuses on novel antibiotics and new drug discovery as well.
Okay, all right, Ekta. Thanks a lot for that. Gurmeet, what do you make of this one? Woki, always a tricky one. The stock, I remember on Monday morning, it started gap up. It was up close to 15%. From there, slam dunk. Big downtick is what we're seeing. Even after this pullback, in the last 1 month, the stock is up 25%. So it appears a bit of sell news has played out over here because the stock has corrected 20% from the top, but it's still up 20% in the last 1 month. At around 1,900 rupees, are you interested?
Nigel, maybe better entry points. So other than Xenic, if you see, they have Vicnoff. There's another one which is on bacterial pneumonia. So quite a list of antibiotics they're working on. I think the decision for them is more to build in-house and then other than go for licensing, which means they want to play the longer game. And this will mean maybe short-term bit of, if you may call it return ratio suppression, margin suppression. And that is why I think you're seeing a reaction today that after the commentary yesterday. So it's a question of how they want to scale. And I think the Xenic is after 20-25 years, the antibiotic has come. So maybe at a better entry point considering what Wukat has done in last 2 years, 3 years, but definitely right up there in the radar. I think also a lot of API names, Nigel, because see, yuan has appreciated 22% against the rupee. Moment anybody set up any API fermentation capacity, China used to cut rates. Now with yuan appreciating, China having their own supply pressures, that will play out. That import substitution will start playing out in some of the API names, some of the specialty chemical names. So I think this space is looking now far more interesting after a lot of pricing pressure for almost 2-3 years.
Got it. Okay, all right. Gurmeet, we appreciate you joining in, giving us all of those details. An important point with regard to the currency as well. We keep cribbing that the currency has depreciated. But in the export market, it could be making us more competitive because the Chinese currency actually has appreciated while we have depreciated as well. Better earnings for the domestic names that are exporting. Slip into a short break on the other side. Rupin Rajguru of Julius Baer is waiting for us. He'll give us his take on the markets and stocks and themes that he likes. Welcome back. You're tuned into Closing Bell. You're on CNBC TV18. Well, it's that part of the show when Hormuz joins us. He puts the spotlight on all the big movers in today's market. Hormuz, take it away.
Today is possibly one of the few days where the index has taken the spotlight over stocks. But of course, there are a lot that are moving in the broader markets. Himadri Specialty Chemicals is one of them. The stock was up around 6.5% yesterday as well. It's extending those gains now, 4.5% higher. So 10% in the last two sessions. Over 2 crore shares have been traded today. The 20-day average is just around about 90 lakh shares. The stock is well above key moving averages. It has remained so over the last 2 months. Almost a quarter of the shares that have been traded so far have been marked for delivery. And in the month of June so far, the stock is up 10%. Yes, the stock was flat in May, but had seen a very sharp recovery after the sell-off in March. It was up around 40% in the month of April. Acutaas Chemicals is one name that has continued to do well. The fourth straight day of gains for the stock. This gained in 4 out of the last 5 trading sessions. The 9 lakh shares have been traded today. 3x its 20-day average. Close to 40% of those shares have been marked for delivery as well. And right from the start of the year, the stock has continued to remain above all of its key moving averages. Of course, as a result of that, the stock is in overbought territory as well. The RSI is at around 74, 75. And the stock made its debut in September of 2021. Issue price of around 610, 620. And the stock is up 5x from those levels. And the last on the downside today, BSE, seeing some profit booking from elevated levels. Capital market stocks continue to remain under pressure today. It declined in 5 out of the last 7 trading sessions, has BSE. Today's session over 55 lakh shares traded. The 20-day averages are under 40 lakh shares. The 50 DMA on the downside, the next level to watch, 3605, still some distance away from there. A third of the shares that have been traded so far are marked for delivery, and BSE today is the most traded stock on the Nifty 500.
All right. Thank you very much, Hormuz, for that. So those are some movers from what's happening today in the broader markets. Rupin Rajguru is with us. He's head of equity investments and strategy at Julius Baer, India. Rupin, good to have you with us here. Thanks for joining in. So let's just start with financials as a space and NBFCs in particular, because the swing both ways. They get hurt the most. They benefit the most because they pay more for deposits as compared to banks. What do you own there in that space? What do you like in that space? NBFCs in particular.
Hi, afternoon, Prashant. You very rightly said that NBFCs do tend to get impacted in a big manner, in a changing interest rate environment. So while in today's context, the status quo has been maintained by the RBI, but they have left a room open for a rate hike sometime towards the second half of the year. That's what our sense is. Within NBFCs, typically, we like diversified NBFCs. So NBFCs which are present into various segments, and they have developed their own niche. So some of the large NBFCs and the cost of funding to them is definitely much better than the smaller NBFCs. So some of the large NBFCs is what typically we like. And Apart from that, we also like home financiers, which are again housing finance companies. So those again, it's in an environment in which there is a little bit of uncertainty. I think we prefer secured assets. So HFCs do qualify in that. But to sum up, in the current environment, our preference would be towards large private sector banks vis-a-vis the NBFCs, because those banks which has a strong liability franchise, they tend to benefit in a environment where the interest rates tend to go up. So those would be a big winner according to us.
All right. Hi, Rupen. Good afternoon. Good to see you in. I think we're speaking after a while. It appears that you are factoring in probably that we are towards the end of the cycle and hopefully of this entire war, actually. And hopefully things actually recover from here on, which would mean that crude oil prices slip. In that case, it appears you're quite optimistic on OMCs. It's a good tactical trade.
Yeah, hi. Afternoon, Nigel. And yes, let's hope that this war ends sooner. As we speak, we are more than 90 days into the war, and I think nobody initially expected that it will go on for so long. And if we go with the premise that the war is going to be ending pretty soon, which are the obvious tactical play, definitely OMCs come into picture. So OMC as a stocks have been moving down since the war has begun. But over last month or so, we have seen steps taken by the government. Government have hiked the prices, so that should cushion the OMCs. Also, they have set up the ATF stabilization fund, and as well as if the oil prices were to cool off from here, definitely there would be a good leverage play on that. And finally, if I were to look into the valuations of these OMCs, which probably before the war they were at say 1.7, 1.8 times price to book, they have now come down to say 1.1, 1.2 times price to book. And typically, in a normalized environment, that is a good time for anyone to get into those stocks. So yes, if there were to be any news flow around the war, and let us all sincerely hope that there is a final resolution to this, OMCs would be a good leverage play or beta play on that.
Okay, all right, got that. OMCs. The other space that I believe you're looking at is defense. Now, in the kind of geopolitical scenario that we have been, faced with, both this year, I think the last 3 years as well, I think have been very, very rocky. Defense stocks, they're not cheap right now, but it appears globally there are going to be tailwinds, as well as domestic spend as well is going to go up from our government. Do you believe that this theme is something that you would like to play with a longer term view?
Nigel, 2 or 3 big themes globally which we believe will play out after the uncertainty, geopolitical and post COVID and all other factors. So one, yes, as you rightly said, defense is one theme, because after the Ukraine war, clearly all countries which were under the umbrella of US security, they suddenly feel the need that okay, that security is not going to be there, and let us now develop our own capabilities around that. So that's one theme. The other theme, which has more come into picture after the West Asian crisis, is the energy security theme. And finally, food as a theme, because ultimately, if the supply chains are getting disrupted, I think one of the basic requirements of food, fertilizer, those, is another big theme which has come up. So specifically talking about the defense, you're absolutely right, and India has recognized it. And in last few years, the Indian government has made phenomenal efforts to get into our own manufacturing, and not only manufacturing but also exporting. And even in this year, almost 5 to 6 lakh crores worth of tendering is expected, which will be not this year, but over next 2 years is expected. So the order books of all the companies related to defense, be it on the manufacturing side, be it on electronic sides and all, are pretty much full. And you might be also getting more order flow. So that's definitely a very strong theme to play for next, probably 5 to 6 years, because this is here to stay.
I got that. This is here to stay. Well, thanks very much, Rupen, for joining us. Good speaking with you. Have a good weekend, restful one, and we'll see you back on Monday. But F&O data and what's moving there, Nigel, take it away.
I'm looking forward to the restful weekend. Got an eye on that one.
Not an exciting weekend.
Rest is important, I think. But let's talk about the markets then. We're still lower again, 60, 65 points or thereabouts. So one factor the bulls will clutch on to is the India VIX is not perking up. Now, that's normally a sign that maybe, in fact, the fear is a little bit, cooling off now. Because normally those two have an inverse relation, right? Markets are down, Nifty is down, the VIX should be up. But that's not happened. So that's one encouraging sign. The other encouraging sign is the Nifty Bank, it appears to be putting in a bit of a fight. If the Nifty needs to fight back, the Nifty Bank needs to put its hand up. And today, the encouraging part was it went to 54,700. From there, it did see some selling pressure. But it's very close to those technical levels. It needs to get past that. That's what will trigger a bigger short covering bounce. But the options data as well suggests that the bears, they want to defend this 23,600 mark. I say that because the premium on the 23,500 call, it was $150 yesterday. It's come down to around 92 rupees. So there is writing on that particular strike. Even when we were higher by 20, 30 points on, the premium out there was lower, telling you there is writing. Even if you look at the 23,400 call, premium has come down, $200 has become 134 rupees. So writers, they are comfortable. They are eyeing that 23,600 mark that it doesn't get breached on the upside. However, a dip towards that 23,200 is going to invite buying. The reason I say that is because the premium out there is around 130 rupees approximately, and at around 130 rupees, you'll have to say the smarter money actually is writing that particular strike. At the lows of today, it was 50 rupees. So there was some buying earlier, but now it appears there is some writing on that particular aspect. 50 DMA on the Nifty will be important. That's the first reference point out there, comes in ballpark 23,650. Individual stocks that are unfocused, well, you have REC. That's coming for a bit of a short covering bounce. Remember, the stock has corrected a goodish bit from the top, but the shorts seem to be getting squeezed out. And from the banking names, Yes Bank, it's spent a lot of time in this 20 to 25 odd mark. But that's seeing some fresh addition in today's trades, long build up out there, and some shots getting built into sale. Now, we'll have to see whether or not there is just some routine profit taking that's taking place on sale, or if in fact there is some change in terms of the fundamentals. But there are some shots in the system on that particular name. Well, time to slip into a short break, come back. Final 30 minutes of trade. Nimish is waiting by as well. He'll tell us what he's picking up in D Street Chatter.
Okay, welcome back. Well, Adani Group stocks are back in the spotlight on the back of those block deals that took place last month in May. I mean, they were worth some 15,000 crores, have changed hands. Well, let's just look at who are the buyers and sellers. Sud has put this together. So take it away.
So as you have said, in the last 1 month, Adani Group shares have seen block deals of more than rupees 15,000 crore, or say $1.7 billion. And some of the major buyers included Capital International, SBI Mutual Fund and Birla Mutual Fund. So I'll start with Adani Ports, which had seen block deals of more than rupees 7,400 crore in the month of May. And seller was Worldwide Emerging Market, while buyers, first buyer Capital Group, which had bought shares of more than rupees 4,600 crore. And another buyer was Euro-Pacific Growth Fund, which had bought shares of more than rupees 2,800 crore. Adani Enterprises too had seen block deals of more than rupees 1,400 crore in May, and seller here was GQG Partners and buyer was SBI Mutual Fund. Remember, even in September 2025, SBI Mutual Fund had bought shares of more than rupees 2,300 crore in Adani Enterprises via block deals. Another name, Adani Energy, which in the month of May had seen block deals of more than 644 crore. And here the seller was Qatar Holding LLC and buyer was Birla Mutual Fund. Even today, we have seen block deals in two major companies. First, Adani Enterprises, where block deal was worth rupees 4,800 crore, and Adani Energy, where block deals were of rupees 960 crore. Details of today's block deals, basically buyers and sellers' name, will only get to know in the evening when the NSE and BSE data come out.
Okay, got it. All right, Sud, thanks a lot for putting all that data into perspective. Let's hop across to Nimish, who's going to tell us about D Street Chatter. Nimish, before we get to that, you want to throw some color on what Sud had to say?
Well, Sud already said that you'll get to know the data towards the end of day today in the BSE NSE disclosures. But my sense is there was a single buyer and a single seller. The seller was a large FII, and a buyer was one of the leading domestic mutual funds. So let's see whether it will get disclosed because it happened in the block window. So disclosure should happen. And maybe that's the reason why, it'll get impacted in the FI data as well, because the seller, to my understanding, was the largest FI and the buyer was a domestic mutual fund. So it'll get reflected on both sides, on the FI side as well on the DI side. So that's basically the feedback as far as the Adani blocks today are concerned. Almost 5,600 crores, so it's a large amount which will get reflected in the institutional data.
Got it. Okay. All right. So that's about that. But run us through the remainder of the chatter then. Flows, how are you seeing things shape up, and then maybe you could fill us in with stocks as well.
Well, Nigel, it's been a volatile day of trade, but at least from a policy point of view and post-policy action point of view, my sense is there is a bit of buying interest back in the financial lane. So large PSU banks, private banks are well bid by the large institutions. So maybe it will reflected in the data as well, and that's the reason why while the Nifty bank is also volatile, it's up almost 0.5% in today's trade. A bit of profit booking, I would say, in the metal names. The index is down nearly 1.5%. No specific reasons to it, but largely it looks like a profit booking after the recent run-up in the metal names in today's market. There is a small MOC sell basket again in today's market, so that will have an impact on some individual names. Largely, it's restricted to the large cap Nifty names as far as the MOC sell is concerned. But broadly, I guess in today's market, apart from the large block deals, if there is a buying interest, that largely seems to be towards the financial names.
All right. What about individual names, Nimish?
The first stock on my list is Kalyan Jewellers. After a long time, some bit of traction seems to be in Kalyan Jewellers. It's up buzzing in trade today, but my sense is at least one of the leading family office has turned buyer in Kalyan Jewellers. Some accumulation is happening at current levels in that particular stock. Second name, as I said, there is a bit of MOC sell. What stands out is Vedanta as well as Ashok Leyland. Both the stocks are going to see selling pressure towards the end from a leading FI. So maybe it will show up in the institutional data and in the delivery data as well. So selling pressure in Vedanta as well as Ashok Leyland. The third name is Schaeffler India. After a long time, some bit of interest is back in that name as well. There are block bids indicated from larger institutions in Schaeffler India. So looks like there are some buyers at current levels in that name. And the last is Meesho. As I said, every second day you're going to see large block deals. While Meesho has been consolidating of late, expect a very large block in Meesho as well very soon. So that's something to track in Meesho. A potential private equity seller in Meesho, which is likely to come very soon.
Yeah, absolutely. Nimesh, so just to link two things completely unrelated, the buyer in Adani stocks and the buyer in Meesho is this. Meesho a few days back is the same.
I'm not sure who was the buyer in Meesho, Prashant. So anyway, so disclosures will come as far as Adani stocks are concerned. As I said, it happened in the block window, so it'll be an institutional, interest on both sides. So
and I think with Meesho, what you're saying is there's a large block coming, but I think the lock-in is ending, right? Perhaps that's what's happening there. Yeah.
It happened. I think the lock-in is ending early next week. So after that, you'll potentially see a large block coming with.
All right. Let's just do a quick check on Z with Nimesh. Nimesh comes up at 3 and we look at Z.
I have nothing more to add, Prashant. I mean,
oh dear. I was just joking.
We first highlighted.
It's up 8%.
Well.
It basically was part of Nimesh's chatter list a few days back. And there is the FIFA excitement, etc. I mean, there's news there. But it's done quite well, very, very quickly. I think from about 70-ish, it's added about 50 rupees in a short order. Nimesh, thanks very much for that. There's 16 minutes to go for close, but let's, Rahul is back with us as we always get some trading ideas here and now. These are short-term ideas. Rahul, what do you have?
2 or 3 observations. I was seeing, Coal India, that's a stock that's taken a bit of a hit today. We've got a close to about a 2% drop. I'd utilize, drops like this to probably enter the stock. And the reason I say this is we've got some very strong support at around 430, just from a super long-term perspective too. And, when you look at the kind of volumes it did a week ago, it's probably one of the highest volumes we've seen in a decade, probably. Maybe the top, if not the second highest. So I think it all points to the fact that there is something, brewing here, and use, declines to get in, keeping in mind that 430 solid support, which is there on the long run. Amongst the heavyweights, another observation, I think what would pull the Nifty down, since I did talk about the Nifty slipping, I think Reliance could be one of those big boys which pull it down. 1245, 1250, that's a target I'd peg on Reliance. So I think even from here, one could be looking at a bit of a downside. If you're looking at a bit of an aggressive buy, and this could be a little risky, that's why I use the word aggressive, it could be a stock like Tech Mahindra. Tech doesn't look good, but I'm seeing signs of some potential pullback move. So if you keep a clear stop loss at 1460, you could even shoot for 1540. Again, this is an aggressive short-term call here.
Okay, 1460. That's the important mark on the downside. I'm just throwing this at you, Rahul. Prashant and Nimish were just talking how they just highlighted that stock. One-way move after correcting big time, 70 to 112 rupees. It's got momentum, it seems, but does it have enough to go even higher from here?
I am of the view that Z actually had a very good breakout, not just price-wise. When you start looking at the kind of volumes it did over the last 3 or 4 sessions, I think that's what speaks a lot to me. So where can it head to? About 125 is where I'd peg the target. I mean, is this an entry point? No. I think we're a bit late on it. You have been probably seeing this on the radar for a couple of days now. But, at these levels, I would be a little circumspect to enter. But, if someone's already into the stock, I'd say 103 is a good stop loss to move with if you're a short-term trader.
Yeah, no, absolutely. Good calls there and a good strong view. We'll, mark the views to market a little later next time you're on, Rahul. But appreciate it, as always. Let's look at the RBI policy from a macro-ish perspective in terms of what the real thrust was. Latha, of course, was the first one to ask the governor about it. Latha, welcome back to the studios. Eventful day and a really buzzing policy.
Yes, we are not talking interest rates, we are not talking inflation, we are all talking rupee. And what a bunch of, announcements. Everything that was being speculated was announced. ECBs, FCNRB, just the whole lot. And, of course, the tax cancellation for FPI debt also came at the same time. And, of course, by design, even the small encumbrances on FPI debt has been removed. They had small short-term bucket, long-term bucket within each bond. All that removed, more bonds available. Just everything has been thrown at them. And that is clearly showing in the currency. Almost a rupee cheaper is what the dollar is. It's about 0.9%. And it's not just that it is 0.9% stronger. It is stronger on a day when all Asian currencies are either weak or at best flat. This kind of an outperformance, I can't remember in a very long time. Now, what can this bring? This FCNRB scheme, that is foreign currency non-resident guys sending money to an Indian bank, that was there, of course, in 2013 as well. At that time, we had got about 25-30 billion. The expectation is the same amount can come in the very least. Of course, now there's competition from, say, a US Muni bonds. They all give even more than the 4.5 that US Treasury gives. But nevertheless, you're going to get, with the hedging cost, over and above what even a AAA mortgage bond in the US will get. So the expectation is at least the same amount will come. Under the ECB route, all PSUs, so, Coal India was rising. For all you know, Coal India could be allowed to raise. Of course, SBI, BOB, PNB would be going out to raise. But you will have PFC, you will have NTPC. The guys who have even otherwise gone to these markets, they get about a concession in their hedging cost. And the beneficiary of all this is also the corporate bond market. Today, the CD market and the corporate bond market saw yields fall by about a 1/4 percentage point, 25 basis points. Why? Because when this money comes, where will you park it first? You'll park it in corporate bonds, right? And when you are getting money, when banks are getting money, this kind of money, FCNR deposits and ECBs, then why should they pay high on CDs? So CD rates also fell. So there has been a positive impact for the borrowers as well in the market. But the biggest one is exporters. They've been asked to bring their money ahead. Now, if you're an importer, until now you would think like, let me go and hedge, let me go and buy the dollars because tomorrow it will be more expensive. If you're an exporter, you would say, let me not give away my dollars. Tomorrow I may get a better price. Now you're thinking the exact opposite. So that is another, the Reserve Bank intervened to the extent of 150 billion last 1 year, if you look at the data. But actual BOP deficit was only 30 billion. Where did the other 120 billion go? It was this extra hedging by importers. Now that becomes exactly ulta. They stop hedging because they expect it to get cheaper, and exporters will come in and rush forward sales Because who knows, today 95, today may be the last day I'll see 96. Today it ends at 95, tomorrow it may go to 94 and a half. So there is this reversal that is happening in the market, and this was already smelt by the NDF market. Today the NDF 1 month forward rate is lower than it is in the onshore market. To that extent, the mood has changed. And therefore, you can see this rupee rally, and the mood in the market at the moment is 93, 94, don't rule out.
Got it. All right, Lata, thanks a lot for that. Not a bad time to have a relook at the foreign travel. Huh? All right, I'll do that since you gave me permission. End of this month. Let's do it. Okay, let's shift focus then to general insurers and how they are fared in the month of May. ICICI Lombard seems to have outperformed the industry with 11% growth. Yash is the expert out there. He joins us to fill us in with the quick analysis. Yash, take it away.
Well, it's a quite strong outperformance which ICICI Lombard has posted in the month of May. It has become the only listed general insurance companies to show any kind of growth in the month of May. And it's not a very marginal growth that we're talking about. It's a good double of the industry average growth which ICICI Lombard seem to have posted. As far as specific numbers are concerned, the premium for ICICI Lombard in the month of May has grown by about 12%. Industry average growth in the month of May is just about 6%. Let's speak about another listed company, Go Digit General Insurance. It has reported a decline or a drop of 1% when it comes to premium collection on a year-on-year basis. New India Assurance, the premium collection is flat on a year-on-year basis. Now let's speak about standalone health insurance companies. The industry average is about 32% growth in premium in the month of May. Niva Bupa has done 30% growth in its premium collection. Star Health has grown its premium by about 19%. So as far as the industry growth rate is concerned, ICICI Lombard, clear outperformer, and of course, growing ahead of the industry, almost double of the industry average growth.
Well, thanks very much. Life numbers expected when, Yash?
Hopefully, first half of next week.
Okay, all right. Well, thanks very much for that. We'll take a break. We're back. More on the other side. Welcome back. I think Anand Tandon is with us for a quick chat. There's about 3 minutes to go for close. Anand, sorry about coming to you a little later, but these RBI measures, you think, the thing is equities are down 50-odd points despite everything which has been announced. So typically on good news, bad price action is not a great thing. But you can argue and say all these measures are for the debt side, debt flows, not very much anything on the equity side. But how would you read it?
Well, I don't put too much stress on the flows alone. I mean, clearly, like you said, the measures are for the debt. However, it will ease flows into equities also. But see, the point is that we think of it as in isolation. Just because we have decided that suddenly we like foreign debt doesn't mean foreign debt doesn't have other opportunities. Don't forget that this is a year where the new US Fed chair has indicated that they may want to reduce their balance sheet by a small amount of about $2 trillion. Now, if you're shrinking your balance sheet by about $2 trillion, and even if you do it over the next 2 years, it is quite unknown what the impact of that in the US interest rate is. At best, it will not spike up. At worst, it may actually surprise on the upside. We still have the tightest spread between the Indian interest rate and the US interest rate for a very long time. Why do you think it is suddenly very attractive to be investing in India, given the general outlook?
Yeah, it's a dire prognosis, Anand.
It's not a prognosis. It is what the man has already said. We are going to shrink the balance sheet. It is currently $6 trillion is the US Fed balance sheet. They have put out a paper which says that between $1.6 to $2.1 trillion is possible to be shrunk without creating too much of an issue by reducing their reserve requirements. Whether that will impact the market, I don't know. I mean, theoretically, it is supposed to be done without pain, but I have never seen it done without pain. You would therefore assume that they will actually go ahead with it. There will be some ruckus in the US market. We are not going to, just because India has, the bureaucrats here have decided that, oh my God, we shouldn't charge income tax. Doesn't mean people are rushing in with bagfuls of money.
But if you make it attractive, people will put in money, right?
For sure, provided it's attractive enough. Like I said, what is the
this
spread
FCNR, for example,
between the two
it can
interest
get in
rates
$30,
and the
$40 billion
inflation?
now. Is it enough is another question. Does it solve the problem is another question. But the money will
I
come.
doubt whether much you'll get anywhere close to that, but then we'll see.
Yeah. But, it's if you offer a high enough rate, right, and you subsidize hedging for banks here on the dollars which come in, we'll see. But there are all kinds of estimates. No way to tell, right? We'll, of course, know in hindsight. But, Anand, the point is broader markets, I think that's the close. Let's just take a couple of more questions with Anand while we show the closing on the side of the window. Anand, taking this broad view, look at what's happening with broader markets, and on the editors roundtable in the next 30 minutes, Nimesh is going to put out a piece just looking at the sheer outperformance just this year in 2026. And this is not focused in just one area. It is the non-FII stocks, if I can put it, where there has been humongous runs.
Yes, there is. And that, to my mind, is a function of liquidity. One thing I learned very early in my investing career is that when you look at the broader market, it behaves like, it has what Mr. Soros used to call reflexivity. That as the market goes up, the performance increases, and the performance increase moves into the market. Now, whether it is because of the fact that capital becomes cheaper and therefore you are able to generate more output out of that capital, or it is because, suddenly the promoters find that it is better that you have more earnings rather than more private earnings, is a matter of discussion and has changed over a period of time. However, by and large, when you are looking at the market, we have to agree on looking at one index. And the reality is that the index one looks at is the main market index. Can you in 4,000 companies figure out 2 or 3 companies which will do great? Absolutely. There is never a challenge on that. The question is, can you consistently build a portfolio where you can put a significant portion of your net worth and then go to sleep with that kind of position? That is where you require a few investors can, most people can't. And that's the reason why you have diversified portfolios and diversified returns. Therefore, to focus, I keep seeing these kind of reports. Oh, if you knock off these 2 sectors, the index has actually done very well. Sure, if you knock off all the underperformers, it will outperform. But, that doesn't tell you anything. The reality is you have a portfolio as an investor which is reasonably diversified, and you are going to get near diversified market returns. And that is what has to be used as a benchmark.
Yeah, but that's the point. And I wish we could speak more, but it's not a narrow set. It's not 3 stocks, 4 stocks, 5 stocks. It is a very large number of stocks which have done very, very well. So, yeah, if you are... but I agree with most. I don't fundamentally disagree with what you're saying, Anand. But I want to push back on a few, but I don't have time to do that. So I'm going to say thank you. Appreciate you joining in, and we'll chat again with more on this. Have a good weekend. It's a wrap of this edition of Closing Bell. Done for the week. Down mostly across the larger indices. Editors Roundtable on the other side.